Today, we're diving deep into CFDs, or contracts for difference. CFDs can be a powerful tool for trading various assets without actually owning them, giving you access to stocks, forex, commodities, and more. But with that power comes a unique set of risks, so it's essential to understand the basics. In today's video, we'll cover 15 things every beginner needs to know before getting into CFD trading. Let's dive in. This is Wealthvelocity. Here you create, protect, and grow your wealth fast. A CFD, or contract for difference, is a type of financial derivative. It's a contract between you and a broker where you speculate on the price movement of an asset without actually owning the asset. You make a profit if your prediction is correct and the price moves in your favor. Conversely, you'll incur a loss if the price moves against your prediction. Understanding that CFDs are derivatives is crucial. You're not purchasing the asset itself, but rather speculating on its price movement. This allows you to enter markets like forex, commodities, and even indices with less capital. But it also means your position is entirely dependent on the contract terms, not on ownership of the asset itself. Traditional investing usually involves buying assets, like stocks or commodities, with the intention of holding them as they gain value. With CFDs, you can go long if you believe the price will rise or short if you expect the price to fall. You don't own the underlying asset, but instead trade based on the price movement. The flexibility of CFDs to profit from both rising and falling markets is attractive, but it also means you need to have a solid grasp of market trends and timing. Unlike buy and hold strategies, CFD trading requires active management and market awareness to be successful. Leverage is one of the defining features of CFD trading. With leverage, you can control a larger position than the amount of money you put down. For example, with 10-to-1 leverage, you only need $1,000 to control a $10,000 position. This can amplify your profits, but it also magnifies your losses. Leverage allows you to maximize your capital, but it comes with high risk. For beginners, leverage can be a double-edged sword, leading to significant gains or severe losses. Start with lower leverage to get comfortable with the risks involved, and always have a risk management strategy in place. Margin is the initial capital required to open a leveraged CFD position. If your position loses value and your margin balance falls below a certain level, you may face a margin call request from your broker to add more funds or close the position. Understanding margin requirements is vital because failing to meet a margin call can result in your position being liquidated. Margin calls are common in volatile markets, so having extra funds in your account or using lower leverage can help prevent unexpected losses. With CFDs, you can go long, buy if you think an asset's price will increase or go short, sell if you believe the price will fall. This flexibility means you're not limited to profiting only from rising markets. The ability to go long or short is a major advantage of CFDs, but shorting comes with unique risks, as prices can theoretically rise indefinitely, potentially leading to unlimited losses. Understanding market trends and having an exit strategy is essential to managing the risks associated with short selling. CFD trading involves several costs. These may include the spread, which is the difference between the buy and sell prices, commission fees for certain assets, and overnight financing charges for holding positions open beyond a trading day. Fees and costs can quickly add up and impact your overall profitability. It's essential to be aware of these costs and factor them into your strategy, especially if you're planning to hold positions overnight, which incurs additional fees. The spread is the difference between the bid, sell price, and the ask, buy price. This is effectively the broker's profit on the trade and a hidden cost to the trader. Narrower spreads mean lower costs, but during volatile market conditions, spreads can widen. The spread affects your entry and exit points. If the spread is wide, it can eat into your profits, especially for short-term trades. Beginners should look for brokers with competitive spreads and be aware of how spread fluctuations can impact their strategy. If you hold a CFD position overnight, you may incur an overnight financing fee. This fee is essentially an interest payment for the leveraged amount and varies based on the asset and the broker. It's typically higher for leveraged positions. Overnight fees can add up, particularly for highly leveraged positions or trades held for multiple days. This makes CFDs less ideal for long-term investing, as the fees can significantly reduce your overall profit. Risk management is essential for any trading, but especially for CFDs due to their leveraged nature. Common strategies include setting stop-loss orders to automatically exit a position if it reaches a predetermined loss, and take-profit orders to lock in profits when a target price is hit. Without a risk management plan, CFD trading can quickly lead to substantial losses. Stop-loss and take-profit orders are vital tools that help you manage risk, avoid emotional decisions, and protect your capital. Choosing the right broker is essential, as not all brokers offer the same features, fees, or level of support. Look for a broker with competitive spreads, user-friendly platforms, reliable customer service, and strong regulatory oversight. A trustworthy broker can make a significant difference in your trading experience. Ensure your broker is regulated, as this provides some level of protection. Transparency in fees and ease of withdrawals are also important to avoid unpleasant surprises. Effective CFD trading requires a good grasp of market research and analysis. There are two main types of analysis to learn: fundamental analysis, which involves studying economic indicators and financial reports, and technical analysis, which focuses on price charts, patterns, and indicators. Market research and analysis help you make informed decisions, reducing guesswork. A blend of fundamental and technical analysis allows you to assess both short-term and long-term trends, giving you an edge in predicting price movements. Trading psychology refers to managing emotions like fear, greed, and impatience, which can lead to impulsive decisions. Emotions are often responsible for poor decisions like over-leveraging, revenge trading after a loss, or holding on to losing positions for too long. Staying calm and disciplined is crucial in CFD trading. Developing a trading plan and sticking to it can help avoid emotional trading. CFD trading can be fast-paced, so it's essential to remain focused and not let emotions dictate your actions. Most CFD brokers offer demo accounts that allow you to practice trading with virtual money. This is a risk-free way to get familiar with the platform, test strategies, and understand how leverage and margin work before you start trading with real money. Demo accounts are invaluable for beginners, as they provide a safe environment to learn without financial risk. Use a demo account to develop your strategy, understand fees and costs, and see how market changes impact your trades. It's an essential step before committing real capital. A trading plan outlines your goals, risk tolerance, preferred markets, and specific entry and exit strategies. It helps keep you disciplined, focused, and consistent in your approach, especially during periods of high volatility. Having a plan protects you from making impulsive decisions and keeps your trading consistent. With CFDs, having a defined risk-reward ratio, leverage strategy, and exit rules is essential for long-term success. Your trading plan serves as a roadmap, helping you avoid emotional pitfalls and stick to your strategy. And that's it. 15 essential things every beginner needs to know about CFDs. Contracts for difference can be a powerful tool for accessing various markets, but they come with unique risks. Take the time to understand these key concepts, practice with a demo account, and develop a strategy before jumping in. If you found this video helpful, please like, subscribe, and share it with anyone interested in learning about CFD trading. Thanks for watching, and happy trading!